And good afternoon, everyone. It is April 2nd, Thursday. Welcome to Morgan Stanley Asia Macro Webcast. My name is Crystal G, Asian EM Market Strategist. Before we start, please note that this event is for Morgan Stanley institutional clients and financial advisors only. It is not for member of the press. If you're a member of the press, please log off and reach out separately. Please also note that this session and your questions may be recorded. Today, we have Jun Suk, South Korea strategist and head of Korea financial research, Riki Ogino, Japan energy and utilities research analyst, Gaten Ku, Asia macro strategist, Chloe Liu, China strategist. During this session, you can send us questions at any time from the Ask a Question text box. So Trump just gave his speech at this morning, and then there is still a lot of volatility in the market. Today, we have Jun here to share the latest market thoughts on Korea. And then also Jun just put out a note to put industrials ahead of semis. So Jun, can you talk through your views and also investor consensus here?
Yes, thank you very much, Crystal. So I guess the question is the storm really subsiding? And I think the share price today, the reaction after the speech from President Trump, we have seen Kospi move down, and it's currently around 3.5% down or more. And even if we do see de-escalation going forward, now our kind of point is that we definitely need to check the waters and see what kind of discernible ripple effects we'll see, because the length of the closure of the Hormuz Strait has been quite extended, and also how the strait will be reopened is also going to be a factor here. So, I think when you look at the volatility of the market, it will kind of continue, and Kospi continues to be the market that's more sensitive to the geopolitical circumstances playing out in the Middle East. Again, there's a lot of sensitivity to the oil side and also other commodities. So it does, that makes sense. On the risk on, as we saw yesterday, again, tends to be the outperformer also. So there is going to be, I think, a lot of volatility. And now, when you look at our kind of view when it started, is that maybe the storm could be stronger than expected, and it actually has been. But Kospi has been able to stay above the bear case of 5,000 that we have, and we continue to believe that this is going to be a level that could be maintained unless, barring a situation where we move to an extended effective closure scenario. So, some of the, I think, important elements of Korea is then that there's been a lot of strong policy support, not only on the economic perspective, but also on the capital markets from the government side. So when you look at the sensitivity to oil, obviously 70% of our oil is coming from the Middle East. LNG, 20%, probably a little bit more sensitivity to LNG in the sense that the reserves aren't as substantial as what we have in oil, but there is also going to be other factors like Korean won, which is now above 1,500 level. So, and I think the other factor has been that Korea has been a very highly overweighted country since last year, and again, another factor that has led to, I think, more volatility for the market. But there is going to be support here, and if you look at kind of recent news flow, the government has submitted a supplementary budget of 26 trillion won to the National Assembly, and this is expected to be passed sometime maybe April 10th, according to the press. And there's going to be a lot of strong support for the SMEs and small businesses, and also the weaker links of the economy. So there seems to be a strong commitment towards providing support. Then we also have the government and the ruling party being pushing the capital market and the governance reform agenda, and this has been quite opportune sometimes and led to the market being more resilient because of these announcements. And what we are waiting for right now is the Capital Markets Act revision. We also have the inheritance tax revision, which is linked to the Anti-Share Price Suppression Act. Then we also have the domestic liquidity measures on the plate, which includes, for example, corporate pension and trying to bring that money into the market. So there is quite a lot happening here. Compared to the commercial code issue, I think the Capital Markets Act and this inheritance tax issues are a lot more, I think, complex in the sense that the details are very important. So the devil is in the details here, and hence I think maybe it may need a bit more time to get ironed out. But I think momentum is still there, and as long as we maintain that, the reform story continues to move forward. When you look at foreign flows, it's continued to be, quite outflows have been quite strong with plus 50 trillion won of outflows during this year. And one of the factors obviously has been the rebalancing factor because of the weighting issues, but there's obviously been some de-risking also. And we find investors to be more on the sidelines for now, as the outcome is still quite uncertain, and the post-conflict also ramifications. We will also have to have a bit more clarity on that. So I think for now, really, the market has been supported by domestic liquidity, which has continued to be quite copious. We have seen retail and institutional, money continue to show positive inflows, generally more through the ETFs. But we have seen actually leverage levels ease somewhat. But again, how the market moves is going to be quite important from here. Now, the initial market reaction to risk on has been, quite strong, as we saw yesterday. But we don't think that the climb to 6,000 is going to be really that quick, even if we see a de-escalation situation. And this is largely because when we are hit by strong storms, there's always going to be ripple effects. And these ripple effects is going to be linked to how long the oil commodity prices are going to remain at an elevated level. And it's also going to depend on logistical costs and how that kind of plays out. So there's a lot in play right now that we need to have a bit more certainty. And it's going to take time to get any kind of certainty on how these higher input costs, logistical costs, and even the potential weakening of the service consumption is going to play onto the various sectors. So we think that domestic consumer, utilities, and transport is where it's going to be more harder hit. Now, when we look at consensus earnings, it's actually still on the upward trajectory, but we have seen IT consensus earnings kind of flatten out in the couple of weeks. But this, does happen when we head into the quarterly earnings season. And Samsung Electronics, as usual, will kick off the first quarter earnings season with prelim numbers coming out next week. Now, our head of Asia Tech, Sean Kim, believes that he's still very positive on the memory story, and he sees the current correction as more of a mid-cycle correction, and that he still favors the DDR, DRAM, NAND, and HDD. So still quite positive on the memory side. Now, positioning is going to be quite important here, and we've actually been kind of pushing for the defensives, and this includes some of the reform plays, and banks, insurers, staples, telcos, even holdcos have actually outperformed during the risk-off period. So, if we are going to see a volatility, this is where we are going to see, I think, a bit better performance relative to the market. But if you go to the risk-on scenario, the potential beneficiaries like defense, energy security plays, and even overseas EPC could be where I think there could be a more upside. Just lastly on defense, this has been we have seen a big surge in the current defense stocks here. Today we are also seeing Hana Aero go up, but a lot of the focus has been on air defense and air power. But we do think that the usage of drones is presenting a cost curve dilemma. So how this is going to play out is important. But again, we do think that the global defense dynamics are making a case for a bull scenario. So I'll stop here and hand it back to Crystal.
Thanks so much, Jun. So before we take any questions on Korea, let's shift to Japan for now. So recently there is some focus back to renewables, and then today we have Ogino-san here, who has been calling for structural cycle in Japan nuclear names as Takaichi beneficiaries. So Ogino-san, can you walk us through the topics and also the key catalysts going forward?
Okay, thank you very much. I am Reiji Ogino, and I am with energy and utility analyst in Japan. And so this Monday, we publish the theme report relating to the Japanese nuclear power situation. And so today I would like to explain our main points of our report. And this report focus on the new Prime Minister, Takaichi Prime Minister policy. Is a focal point. And I'm sorry, this report does not include that today's Middle East situation. So today my presentation is about only the Takaichi Prime Minister government policy. And so this February, 2 months ago, in Japan, there is the political general election, and Prime Minister Sanae Takaichi win this political general election. So therefore, we think Takaichi Prime Minister, basically Takaichi Prime Minister like nuclear power and fusions. So therefore, we think Takaichi Prime Minister would enforce or promote the nuclear power in Japan. So this report, there are five themes. One is theme one is the today's nuclear situation in Japan. This is theme one. And theme two is about the Japanese government long-term energy policy. This is theme two of this report. And theme three refer to the Prime Minister Takaichi political stance about the energy policy and nuclear power policy. And theme four explains our outlook about nuclear outlook in Japan 2040 or 2050. And lastly, theme five refer to the preferred stock in Japanese utilities. My preferred stock in this report is Hokkaido Electric Power. Code number is 9509. 9509 Hokkaido Electric Power. We like Hokkaido Electric Power. Okay, so this is the summary of our report. So let's go to the theme one. Theme one of this report refer to the today's situation of nuclear power in Japan. Now there are 33 units, nuclear units in Japan. And 15 years ago, Japan had a very big earthquake and Fukushima accident 15 years ago. And so just after Fukushima accident, the Japanese government request the electric utility companies to stop all the nuclear power units 15 years ago. And after the Fukushima accident, there are now 14 units already restarted from Fukushima accident. So now today, 14 units operation in commercial. And one more today, one test run, one test run unit, this nuclear unit of the Tokyo Electric Power. Tokyo Electric Power, we do not cover the Tokyo Electric Power, but one of nuclear unit of Tokyo Electric Power is now under test run. And we think in our outlook, next year, 2027, one more unit would be restart. Next year, we think Tomari number 3 unit of Hokkaido Electric Power, Tomari number 3 unit. We now no operation of Tomari number 3, and we think next year, next July, Tomari number 3 unit would start to operate. So therefore, our preferred stock is Hokkaido Electric Power. Okay, so this is today's Japanese government, today's nuclear situation of Japan. This is theme 1. And let's go to theme 2. Theme 2 explains the long-term government energy policy toward 2040. And please look at the Exhibit 6. So this Exhibit 6, this is political target of the Japanese government, fiscal year 2040. So the Japanese government in long term, Japanese government want to increase the ratio or power generation ratio of nuclear power. So okay, please look at Exhibit 7. So nuclear, so March of 24, the ratio of nuclear only 8.5%. But this is March of 24 case. And March of 41, 2040, 20% ratio. This is Japanese long-term target. This target is political, no conviction. But the Japanese government wanted to increase the nuclear power generation ratio upside in long term. This is about theme 2 of our report. And about theme 3 of our report, this is Prime Minister Takaichi basic stance about energy and nuclear power. So please look at 3.1 sentences. And so that they wanted to, they means the Prime Minister wanted, Prime Minister Takaichi wanted to accelerate nuclear plant restarts. So we hope or we think rest of non-restarted nuclear power units would be restart in long term. Not this year, not next year, but in next 3 or next 5 years, we think more units would be restarted under the Takaichi Prime Minister government, we think. This is theme 3. And about the theme 4 of our report, nuclear power outlook for 2040, fiscal year March of 41. And there are three scenarios for our outlook. And in conclusion, we emphasize the Japan need new building of nuclear power unit. Now Japanese government focus on the more restart of existing nuclear power units. And we think in Japan, in next 10 years, there would be new building of AI data center or new building of semiconductor factory. These factory or these AI data center needs more power, more electricity. So we think the Japan needs new building of new nuclear power unit. So we think in next 3 years, Takaichi Prime Minister would make the new policy relating to new building of nuclear power unit. In our opinion, this is the theme 4. And so lastly, theme 5 of our report. This is implication of my coverage, Japanese energy utility. And conclusion, preferred stock is Hokkaido Electric Power, code number is 9509. And so Hokkaido Electric Power, we think Hokkaido Electric Power would restart their Tomari number 3 unit in next year, next July. Okay, so thank you very much. I finished my presentation.
Thank you so much, Yukino-san. That's a super comprehensive introduction. So next we will move on to Gek, and then can you talk us through, first of all, the dollar views in the house, and then how does the macro uncertainty impact your views on EM currencies?
Yeah, sure. Thanks, Crystal. And so on the dollar side, we actually have a neutral view at the moment, mainly because we think there's a bit of a differentiation between the near-term view and medium-term view. So near-term, we do think there's a bit more upside for the DXY towards, say, around 102 is sort of the level that we're looking at. But then in terms of the medium term, we're not sure it can really continue rallying in the same way as we've seen so far. And that's mainly because if we think about the dollar framework, there are a couple of angles that we look at. One is if we look at the different scenarios under the current situation, if you get a de-escalation, if you get ongoing tensions or a renewed escalation. And we looked at the beta of currencies to oil and to equity volatility, and we plug in some assumptions around where we think these two variables would be in the three different scenarios. So what we get to is that in the de-escalation scenario, DXY will have downside, but also if we are in this ongoing tensions or even increased tensions scenario, then the DXY could have upside. So this is sort of what underpins the near-term view that we have for the dollar to go a bit higher. But then the second sort of angle that we're looking at as well is the relationship between US real interest rates and the dollar itself. So because right now the environment we're in is one where you have equity volatility being pretty high, but also real yields and inflation expectations are rising at the same time simultaneously. So historically, when you have this sort of environment, the DXY dollar does do well. And this is the environment that we're in. But when we think about which environment we could move to next, it could be one where we're moving towards lower real yields and inflation expectations, but also equity volatility remains high. And this is where we think markets might start to price in the growth downside risks amid this higher oil price situation. So in a sense, the demand destruction scenario. So interestingly, when we look at the historical performance, when you get this sort of moves in real yields and break-evens, the DXY is actually quite stable because it's torn between downside pressure from lower real interest rates, but also upside pressure from lower inflation expectations, which is usually signaling a bit of a risk-off sentiment there. So this is why we're sort of thinking that we wouldn't really want to be trapped in this dollar bull trap in a way, because we do see this dollar going up in the current environment. But when we move to the next regime, which we think is a sort of defensive regime, the dollar might not actually do a lot in that sort of scenario. And the third angle to consider as well is in terms of the risk premium that's priced into the currency, because what we've seen is that with this rally that we've seen in DXY recently, all the risk premium that was priced in the dollar post Liberation Day last year has been taken out, which we think if things sort of settle down a little bit, then there is room for more risk premium to be priced back into the dollar, which would then argue for a bit of dollar weakness there as well. So that's why when we put all of these factors together, we're sort of thinking, yes, there's a bit of upside pressure for the dollar in the near term, but then we wouldn't want to be trapped in this dollar bullish narrative as well. So in terms of how that sort of impacts Asia FX, we also went about to do some exercise in terms of screening for which currencies might do a bit better or underperform under the three different scenarios of de-escalation, ongoing tensions, or renewed increase in the geopolitical tensions, and try and pick and pair currencies that can do well or underperform across the three different scenarios. So we looked at a few angles. One is the beta of currencies to oil and to VIX, sort of the similar exercise that we did for the dollar, and conditioning it on when the oil curve was very backwardated as it is now, or using the betas during the Russia-Ukraine conflict in 2022 as a reference. And we also looked at the fundamental exposure of each of the Asia economy to energy and food disruptions through things like exports to the Middle East, the oil and gas trade balance, fertilizers trade balance, inventory levels. And also we looked at the external stability indicators like the current account, FX reserves, and what happens historically when we're in a high equity volatility environment with rising real yields and inflation expectations versus with falling US real yields and inflation expectations, which is the next potential regime that we think we might shift to. So when we screen for all these different factors, the conclusion that we got out of there is that if you have higher oil prices that's generating growth downside concerns, then CNH and Sing dollar could actually relatively outperform against currencies like Korean won and Indian rupee and Philippines peso. And then in the alternative scenario where you have the geopolitical tensions easing, then Asia currencies should see a rally across the board. But then Korean won and Thai baht will likely be outperforming because of the higher beta. Sing dollar should also benefit as well because it gets influenced a lot by the dollar side of the story. And INR and Philippines, we think they might also see a relief rally, but then the sustainability of the move could be questioned if we have energy prices staying higher for longer. So if we sort of think about all these different scenarios, then the most consistent relative value plays would be looking for Sing dollar and CNH outperformance versus, say, the Indian rupee or the Philippines peso. They screen quite well across all the different three scenarios that we've looked at. And I mean, the RBI has been coming up with some FX measures in the past few days to try and smooth or reduce some of that speculative downside pressure on INR. So we do think it can help to provide some near-term support for the currency by reducing the speculative activity, but we also think more is needed to really change the medium-term depreciation pressure, because the fundamental factors that have been driving the currency weakness are like equity outflows from the foreign investors and also concerns that there might be more dollar demand from the importers because of higher oil prices widening the trade deficit. And these factors don't seem to have changed given the current global backdrop. So that's why we think the measures might help INR in the near term, but for the medium term trajectory to change, we do need more fundamental factors to be changing as well. So that's how we're thinking on the FX side. On the rate side, it's a bit more idiosyncratic. So I'll say in terms of the global team, the US rates team have actually turned a bit more bullish on US duration last Friday. So they've actually they're now actually suggesting positioning for lower yields as well as a steeper curve. And that's mainly because they're seeing some signs that markets might be pricing in a little bit more on the growth risks as compared to just focusing purely on the inflation risk. If we look at the 1 year forward, 1 year inflation swap. So that is helpful in terms of thinking about the EM local rates, particularly for Asia, where the correlation with US rates is quite high in certain markets here. But then the thing is, when we look at positioning, it's not really clean enough for us to be turning more constructive, because if we look at the sort of foreign investor outflows from EM local currency government bond markets this year, they've reversed about 2/3 of the inflows that we've seen year to date. So it's not really completely reversed all the inflows that we've seen just yet. So positioning is, you could say, not clean enough yet. Plus also, given this uncertainty and also the potential for oil prices to be higher for longer, we think it makes sense to stay a little bit more defensive on EM local markets at this point. But there are some idiosyncratic stories where, for example, in Korea, we have quite a lot of rate hikes being priced in already. And so we would be looking for opportunities to position for lower yields, given that we don't think the amount of hikes priced in will be materialized. And then for places like India, we do think paying interest rate swaps on dips still makes sense, because there's still the inflationary pressure from higher oil, as well as the risks with regards to the oil prices putting some burden on the fiscal deficit. Plus also, if we have the currency sort of staying under pressure in the medium term, then there also could be room for liquidity to tighten as well. And we do like to maintain a steepener trade in Thailand, for example, as well, mainly because we think the rate hike expectations are also unlikely to be materialized. So front-end rates can stay quite anchored, whereas higher inflation and the prospect of more expansionary fiscal policy can help the yields in the belly and the longer end of the curve to sort of underperform or go higher. So yeah, maybe I'll pause there and hand it back to you, Crystal.
Thank you so much, Gak. And then last but not least, our China team have published their best business model. Chloe, if you're online, can you share the key names and also methodology?
Yeah, sure. Thank you, Crystal. So hi, everyone. Today, I would like to walk you through our best business model, the version 2, which we just published this week, and explain how we think about identifying the high-quality companies in the current market. So if you look at the China equities today, one thing that stands out is that the market leadership tends to shift very quickly. At different points, the performance can be driven by the policy changes, thematic trends, like AI, or some shift in the macro expectations. So rather than trying to anchor purely on one factor, our approach is to focus on something more consistent is the underlying strength of the company's business model. So by that, we mean we are trying to find the companies that could generate sustainable high returns on the capital, and also they have very clear competitive advantages, and also they are positioned to deliver a very steady earnings over time. So historically, we see this type of companies tends to deliver very resilient performance across cycles. So here is our framework. Actually, this framework is not new. We launched the first Asia-based business model in 2009 and China-based business model in 2023. And now the version 2 is really an evolution. And so currently, we have some key upgrades on this version 2. First is that we add the assessment on the AI exposure. So we now classify the companies into AI enablers, adopters, and these are relatively insulated. And then we definitely exclude the companies that have some potential disruption risk from the AI into this best business model. And also we align the best business model with the Morgan Stanley Global Research 4 key themes this year, which include is the AI and tech diffusion, the future of energy and the multipolar world, and also the societal shifts. So this could help the portfolio to be more exposed to the structural growth drivers. And then another key upgrade we did in this version 2 is that we have a more active sector allocation. So in version 1, our sector weights are more close to the benchmark. But in version 2, we take a more active approach. Definitely, we are overweighting for the sectors that have stronger earnings growth, more policy support, and also more strategic importance. So currently, we have more sector weighting towards the sectors, including IT, industrials, and materials. So this is the framework of our best business model. And then regarding the methodologies, we can see that definitely. So in step 1, we just identifying like around 700 stocks, and then we go through the quantitative factors, including the factors on the profitability, on the capital efficiency, risk metrics, and also we look at the valuation factors, which we look at the price to book, EV to EBITDA, and the free cash flow yield. So this ensures that we are not just picking the high quality companies, but also considering the entry valuations. And then after that, we overlay this with our fundamental analytic view, and also overlay this with the AI exposure, global themes, and also geopolitical considerations. And then we come up with a portfolio construction. And so currently, for the final list, we come up with 26 stocks across 16 industries. So this is quite a concentrated portfolio because we think the concentration helps to maintain conviction and avoid dilution returns across the too many names. So for this portfolio, we can see its historical performance actually is quite good. So first, on the ROE side, for these 26 stocks, it delivers ROE around 17%, which is 1.5 times of MSCI China. So structurally, it's a higher quality portfolio. And on the valuation side, the forward PE is trading at around 14 times PE, with around 2.5 times PB. This represents a valuation premium versus MSCI China, but we think this is justified by its stronger profitability and better earnings visibility. And also on the Sharpe ratio side, we see this portfolio deliver around 1.2 times Sharpe ratio during the past 3 years. And lastly, on the performance side, this is simulated historical relative performance of our best bid model version 2 versus MSCI China. We can see that starting from 2023, the portfolio could deliver around 100% total return, and this is about 83% outperformance versus MSCI China. So on the sector positionings, so currently in the best bid model version 2, we have a higher exposure to the industries, including like IT, industrials, and materials. So the green bar is their sector weight in our best bid model 2, and the blue bar is the index weight in MSCI China. Actually, because we see these three sectors have consistently higher index weight in the past few years, given they have a higher earnings growth, they are more in line with the national strategic development, etc. So that's why we want to put more active weight in these sectors. And then we can take a final look at the names we identified in the 26 portfolio. So let me briefly highlight a few names. So here we put for names like Tencent, which has ROE around 20% and also have a very strong ecosystem and monetization. And the AI could also enhance their ads, gaming, and cloud business. And fifth one is Alibaba, and we see this is a leading AI cloud platform in China. And also it has a full stack capability across the chips, cloud, and applications. And we also put names like CATL. This is a leading company in EV battery and the energy storage side. And currently with the oil price higher for longer scenario, we think it could also benefit from the electrification of the AI and also the AI related power demands. And we also put names like Zijin Mining, which leverage exposure to the copper and gold. So it's also leveraged to the energy transition and the global demand. And also for names like Ping An Insurance, which has a very consistent profitability and a strong integration of AI in operations. So to summary, so we basically focus on business quality as a core selection principle. And add some AI integration, global themes, and also more active sector allocation into this portfolio. And we end up with 26 stocks. For the details for investors interested, you can look at the report we published today and also the details of the stock list in Exhibit 10. With that, I will stop here and pass it back to Crystal. Thank you.
Thank you very much, Chloe. Now we are moving on to the Q&A session. So the first one is for June. Do you have any concerns on the forward earnings trend and then with the continued weakening of Korean won?
Yes, thank you for the question. So we've seen the USD Korean won move from 1450 level to like 1510 within the past quarter. And when you look at the Korean won impact, it's kind of like a double-edged sword because it does benefit the net exporters and the large corporates, which tend to be more net exporters also. But it also is very negative for the small, mid-size businesses and the smaller kind of Sohos also. So they'll be hurt by the weaker Korean won, and because they tend to be net importers and or actually vendors to the exporters. So I think the other factor is that also the large corporates have the ability to hedge their FX positions, while also SMEs do not. But we also get the question about whether how BOK could react here because of the weaker won, because again that could affect the policy rate factor. But our economist Kathleen still expects that policy rates will stay where it is, and of course if the Korean won weakness is extended, we'll have to see how they react. But on a market standpoint, it generally is going to be more positive in the near term for Kospi, because the Kospi consists of earnings, because earnings contribution from the net exporters make up around more than probably 3/4 of earnings. If you look at this year's earnings, around 55% of the consensus OP is basically tech, and so foreign currency translation gains should be quite positive. In terms of the competitive advantage from the weaker won, doesn't really seem that as meaningful as it was, let's say, 10 years ago, but certainly it does probably help out sectors such as the auto OEM side. So where we do expect more, let's say, weakened earnings is probably going to be sectors such as the domestic consumption side, where they are net importers and they're actually importing a lot of raw materials. But also, if the oil price is going up and electricity prices, which are still standing pat, overall, I think the commodity prices would be going up, also with the logistical prices going up. Same thing with utilities. Again, higher input costs will hurt them, and so will the weaker won. Then we have also transport, especially like the airlines, where there's like limited room to really kind of reflect all of the oil price increases, and of course the Korean won is kind of the double whammy there. Banks also tend to have a bit of a negative impact from the weaker won. Not all the banks have a P&L effect, but certainly it does have a negative effect on their capital. So I think the way I would kind of put this is, in the near term, maybe not so negative, but if this is extended, it will certainly, I think, hurt the economy, and that will also hurt a lot of parts of the consumption cycle.
Yeah, thank you, Jun. There's another question for you. Can you update us of the current state of supply chain concerns, like for example the inventory cost contribution of the key raw materials like helium and sulfur, especially in semis and industrials?
Yes, quite an important element. Obviously, the tanks and the ships that left the Middle East in early March have mostly arrived in Korea, and from here, it's probably using up the private and public reserves until the situation is normalized. And Korea does seem better positioned within the Asian context. I mean, if you look at the reserves right now for crude oil, when the situation started, it was at around 200 days. LNG is around 15 days. Fertilizer 80 days. Propane 70. It seems like helium is around a few months. So it does seem like there is a good reserve level here. But I think one question we get a lot from investors about LNG, because the reserve level is relatively lower, and with what's happened in Qatar, it could be a more kind of a more extended issue. So when you look at LNG, I mean, it's the dependency on Middle East is lower than crude oil, which is around 70%, while for LNG is around 25 probably. And also when we look at LNG, it's a lot more diversified, because Australia is actually the biggest supplier at around 27%, and then we have ASEAN and also the US. So the key question is going to be how long this closure kind of lasts, but we are already seeing measures being implemented to control the utilization levels. And for example, crude oil, the so-called emergency level has been raised another level to the second highest within the 4-tier system. Public agencies and public parking facilities will be using a kind of a staggered vehicle parking system. So from next week. And if push comes to shove, there could be also like restrictions on the driving side, again, with a kind of a staggered system. So, for now, I think it seems like it is not great, but again, I think we're relatively better positioned.
All right, that's super clear. Thanks so much, Jun. We have another question for Kino-san. How do you think the utilities company are thinking about the stranded asset risk of LNG infrastructure in Japan if it will be replaced by nuclear over the next few years?
Okay, thank you for your question relating to the Japanese electric utility power generation side. Okay, so please look at the screen share theme 2 of our report, and please look at exhibit 7. Okay, so as I say, this exhibit 7, the political target of Japanese government relating to the breakdown of power generation toward March of 40. And nuclear, as I say, the ratio would be upside. And about thermal, March of 24 was thermal means gas fire, coal, and oil. And March of 24, 68%. And 2040, political target, 30 or 40%. And we think this 2040 target, 30 or 40% mainly gas-fired energy. So in long term, until 2040, Japanese government wanted to decrease the power capacity of oil-fired and thermal coal-fired. And so we think, according to this Japanese political target, in 2040, the gas-fired power generation must be existed in 2040. So if we discuss about in next 5 years or in next 10 years, after today's Middle East crisis, I think the ratio of coal fire in Japan down, and I think gas fired upside, nuclear upside. That's okay.
Yes, thank you so much, Ogino-san. We have another question for Jun. Do you see any meaningful changes to the Korean market from the reform side, from the reforms both enacted and also planned?
Yes, thank you very much. Yes, we actually do think that the reform is a very important element, and one of the reasons why the market has been able to again go up, and also one reason why it could be more resilient. And so the commercial code revision is done. We've got over the AGM season, and we saw a record number of shareholder proposals, again, quite positive. We are also seeing a government preparing even more reform measures at this point. So this involves like Capital Market Act revisions, such as the M&A rules, potentially even other changes. Then we have the Anti-Stock Price Suppression Act, which is also being discussed. So basically, for inheritance tax issues, 0.8 times will be used as kind of the base, as the base level, even if you're trading below that. And then there's also the disallowing of duplicate listings. So there's a lot on the table right now, and our kind of view on this whole process has been that I think overall we see corporate reform at around third innings on a baseball standpoint. Policy is probably further along around fifth innings or so. And I think another again is that next year's AGM season should be also more interesting because the cumulative voting doesn't really kick in until September this year. So there seems to be a good kind of a flow or sequencing of events that is going to push the story. And we're also seeing signs of national pension becoming more vocal on the shareholder actions. And there's also going to be, I think, probably changes to stewardship code and even a framework to how they kind of mandate decisions towards the outsourced institutions. So a lot happening there. We also seeing, I think, a lot more, actions by shareholders. And, I think all this is kind of really pushing a story where, reform is going to be not something that is going to be, I think, more sustainable. And I think, what we actually did this report recently, and what we tried to do was to assess, where the upside is going to come from on corporate DNA shift. So, basically our kind of conclusion is that capital management is a low-hanging fruit, but there's certainly a lot of potential from ownership and business structure changes. So, if this all works out quite well, a sizable step-up scenario within 2-3 years, we are thinking that ROE could, reach around 12% level. So that would be quite a lot of upside. I'll stop here.
Thanks so much, Jun. In the interest of time, we'll conclude today's podcast here and answer remaining questions offline. Thank you so much for joining again, and do reach out to me and the team if you have any other questions. Have a nice day, and we'll see you next week.